Hello and welcome. Today we're going to explore something that affects every single person living in the UK, whether you're a student, a business owner, or just someone planning your next holiday. We're talking about the British pound, sterling, and why its recent strength is making headlines and sparking conversations across the country. The pound is more than just the cash in your wallet. It's a symbol of the UK's economic health and a key player in the global financial system. When the pound gets stronger, it can have a ripple effect on everything from the price of imported goods to the cost of your summer holiday. You might have noticed headlines recently about the pound surging in value, and financial experts debating what it means for the average person. As of today, the pound is on an upward trend, gaining strength against major currencies like the US dollar and the euro. This isn't just a blip on a chart, it's something that could impact your daily life. What does this mean for you? Well, your pound now buys more dollars or euros than it did just a few weeks ago. That's great news if you're planning a trip abroad or shopping for imported products. But why is this happening? Is the UK economy suddenly booming, or is there something else at play? The answer is a bit more complicated. While the economy has shown some resilience, this recent surge isn't just about growth or optimism. A stronger currency can be a double-edged sword. It's fantastic for holidaymakers, students studying abroad, and anyone who loves to shop online from overseas retailers. But for UK exporters, businesses that sell goods and services overseas, a stronger pound can make their products more expensive and less competitive, which can hurt sales and even threaten jobs. The real story behind the pound's rise is more complex than it first appears. It involves something called a short squeeze, a situation where traders betting against the pound are forced to buy it back quickly, driving the price even higher. Imagine you're planning a trip to Spain. Thanks to the stronger pound, your money will go further, letting you enjoy more tapas, or maybe even upgrade your hotel. But for UK businesses that rely on selling goods abroad, this can mean shrinking profits and tough decisions about pricing and staffing. So, is this a lasting trend or just a temporary spike? That's the big question on everyone's mind, from city traders to small business owners. In this chapter, we'll break down what a short squeeze is, why it's happening now, and what top analysts are predicting for the future of the pound. We'll also look at how all of this ties into the Bank of England's next move on interest rates, and what that could mean for your mortgage, your savings, and your everyday spending. The value of the pound, interest rates, and your mortgage are all connected in ways that might surprise you. Even small changes can have a big impact on your monthly budget. My job is to help you see the bigger picture, so you can make informed decisions about your money and your future. So, grab a cuppa. Let's demystify the markets together and find out what the pound's journey means for you. Let's make sense of a short squeeze. It's a term you might have heard tossed around in financial news, especially when markets get volatile and prices move in unexpected ways. But what does it actually mean, and why does it cause such a stir? Imagine your neighbor Dave thinks Apple prices will crash. He's convinced that soon, apples will be worth much less than they are today. So, he decides to make a bet against apples, hoping to profit if he's right. Here's what Dave does. He borrows apples from a friend and immediately sells them at today's price. His plan is simple: wait for the price to drop, then buy the apples back at a lower price, return them to his friend, and pocket the difference as profit. But what if things don't go as planned? If, instead of falling, apple prices start to rise, Dave is in trouble. He still has to return those apples, but now they cost more than when he sold them. The higher the price climbs, the more money Dave stands to lose. Now imagine there are lots of people like Dave, all betting against apples. If prices keep rising, they all rush to buy apples back at the same time to limit their losses. This sudden, frantic buying pushes prices even higher, creating a feedback loop. That's a short squeeze, a rapid, often dramatic price jump caused by panicked buying from those who bet the wrong way. It's not just about apples. This can happen with stocks, currencies, or almost any traded asset. In currency markets, the same principle applies. Let's look at the British pound as an example. Many investors might bet against the pound, expecting it to fall due to economic uncertainty or negative news. They sell pounds they don't own, hoping to buy them back cheaper later. But if the pound unexpectedly rises, those investors are forced to buy it back quickly to avoid even bigger losses. Their rush to cover their positions drives the price up even more, sometimes in a matter of minutes or hours. This isn't about sudden faith in the UK economy or a wave of positive news. It's a technical market reaction, triggered by traders scrambling to limit their losses. The pound's rally, in these cases, is less about genuine optimism and more about investors being forced to buy back what they sold. It's a scramble, not a celebration. So, when you see headlines about the pound surging, remember, it might just be a short squeeze at work, not a sign that the economy is suddenly booming. These moves can be dramatic and grab headlines, but they're often temporary. Once the panic buying ends, prices can settle back down just as quickly. The real question is, what happens when the panic buying stops? Will prices stabilize, or could they even reverse? Understanding short squeezes helps you see through the noise and make sense of wild market swings. It's a reminder that not every price surge is a sign of strength. Let's see what the experts think about what comes next, and how you can spot the signs of a short squeeze in the future. So, why do analysts, like those at ING, think this is a short squeeze? For months, big investors were negative on the UK, betting the pound would fall. When a little good news hit, the crowded trade flipped. Investors rushed to buy back pounds, causing a sharp rally. ING says this isn't a vote of confidence in the UK, but a technical adjustment. If it were real optimism, we'd see strong economic news. We're not. A short squeeze rally is often short-lived and can reverse quickly. ING's message: don't get carried away by the pound's sudden strength. The foundations are shaky, not solid. Is this pound rally here to stay? ING's analysts don't think so. They see it as a temporary blip, not a sign of lasting strength. There's no big positive news to justify a surge, just a technical market correction. ING predicts the pound might end the year around 1.34 against the dollar, but don't expect fireworks. Against the euro, they expect the pound to underperform, hinting at deeper UK weaknesses. If the UK economy were truly strengthening, the pound would rise across the board. Instead, ING sees this as a short-term move, not a new trend. The real test will be what the Bank of England does next. That's the next piece of the puzzle. Let's decode swap spread, a key clue to understanding the pound's recent moves in the financial markets. If you've ever wondered why the pound sometimes swings up or down, swap spreads are one of the hidden forces at play. They're a bit technical, but stick with me, and you'll see why they matter. First, let's break it down. A gilt is simply a UK government bond. Think of it as a loan you give to the government, and in return, they pay you interest. Gilts are considered very safe, almost like the backbone of the UK's financial system. Now, a swap is a deal between two parties to exchange interest payments, usually to manage risk or lock in costs. These swaps are common in the financial world, helping companies and investors handle uncertainty about future interest rates. The swap spread is the difference between the interest rate on swaps and the rate on gilts. When this gap widens, it often signals financial stress or uncertainty in the market. When it narrows, it can mean things are calming down. Recently, the 10-year gilt swap spread narrowed, which suggests there's less stress in the system right now. Investors are feeling a bit more confident, and that's reflected in these numbers. This narrowing has helped stabilize the pound, making it less volatile. But remember, it's not a magic fix for all the UK's economic challenges, just one positive signal among many. Think of it like your blood pressure dropping a bit after a stressful day, not a full recovery, but definitely a good sign that things are moving in the right direction. It's a small but important improvement. That's one reason the pound has rallied recently. But remember, there are many other factors at play, like economic data, political events, and global trends. The big picture is still complex, with lots of moving parts. Swap spreads are just one piece of the puzzle, and they interact with many other signals in the market. So, while swap spreads matter and can give us valuable insights, they don't tell the whole story about the pound's future. It's important to look at the full range of economic indicators. Next, let's explore where the pound could be headed and what other clues we should watch for in the markets. Where's the pound heading? ING predicts it could hold recent gains against the dollar, ending the year near 1.34. That's steady, not spectacular. Against the euro, though, ING expects the pound to weaken, possibly above 0.88 EUR's GBP. Why the difference? It's all about central banks. The US dollar might weaken, helping the pound, but the Bank of England is expected to be more dovish than the European Central Bank. That means lower UK interest rates, which usually weakens the pound. The short squeeze gave sterling a boost, but the fundamentals point to a tougher road ahead. If you're making plans based on today's rate, be cautious. The pound's path is far from certain. The next move depends on the Bank of England. The real driver now, the Bank of England. ING expects the bank to start cutting interest rates soon to boost the economy. Lower rates make borrowing cheaper, but usually weaken the pound. For investors, lower UK rates mean less incentive to hold pounds, so they may switch to euros. The bank faces a tough choice: keep rates high to support the pound, or cut them to help the economy. Either way, their decision will shape the pound's future. If they cut rates, expect the pound to struggle, especially against the euro. The next few weeks are crucial. All eyes are on the bank's next move. So, what does this mean for you? A stronger pound is good news for holidays and imported goods. Your money goes further abroad and at home. But if the pound weakens, those benefits fade fast. If you're planning a trip, consider locking in today's rate. It could change quickly. For homeowners, a rate cut means lower mortgage payments. For savers, it means lower returns. The market's a balancing act. What helps borrowers can hurt savers. The pound's moves reflect these shifting forces. Stay alert, things can change fast. The Bank of England's decision will affect your wallet. Make informed choices, not guesses. To sum up, the pound's recent rally is likely a short squeeze, not a sign of lasting strength. ING and other experts urge caution. This is probably temporary. The pound may hold up against the dollar, but could weaken against the euro. The Bank of England's next move, likely a rate cut, will be key. For you, this means holiday money, mortgage rates, and savings returns could all shift soon. Don't assume today's strong pound will last. Watch the bank's decision closely. The fundamentals suggest a tougher path ahead. Stay informed, be cautious, and make decisions that fit your finances. Thanks for watching.